Your retirement planning is one of the most critical decisions in planning that you'll probably ever do in your life. Where do you think most people are getting that advice from? You'll be shocked. Welcome everyone. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner, president of Pure Financial Advisors. And of course, I'm with the big man, Big Al Clopine.
How you doing, Joe?
I'm doing fantastic because we're talking about financial advice, and that's the business that we're in. And if you think about it, where do you go to get your financial advice from? Most people are getting it from friends and family. If I'm looking at this, 62%. So it's like, all right, Big Al, I'm looking at retirement. He's 20 years older than me. Why would I go to Big Al? Because his situation is completely different than mine. We might have different goals, different aspirations. Of course, we have different assets. So going to your friends and family might not be the best choice. Look at this, Facebook, Instagram. People are going to Facebook, Alan, to get their financial advice.
That's hard to believe. By the way, I'm not 20 years older than you.
18.
17
and a half, right? But Facebook and Instagram, what are you doing? You're scrolling to find stocks, and then you're gonna blow up your overall retirement. Don't Google your retirement plan. That's today's financial focus. All right, facts versus fiction. You know, when you take a look at some of these articles that are online, you Google retirement planning, you will spend your entire retirement online, right? Because there's so much information out there, and a lot of it is wrong because they're pushing product potentially, right? They could be from distributors or insurance companies, mutual fund companies, things like that that are trying to push you in a certain direction to make decisions potentially to buy their overall product. When you Google retirement planning, it's probably not the best choice. You want to take a step back and figure out exactly what you need to do and get the proper advice that you need and go to the appropriate sources. And who else to show us the way is Big Al.
So you're going to Google for your retirement planning. I'm not saying it's not a good idea to get educated, but just be careful, right? Because if you're going to Google or articles or other sources like that, it may encourage you to do market timing, which we're going to show you is not necessarily a good way to handle your investments. It may encourage you to chase trends. The hot stock, what's the hot stock today? Should you buy it? Typically when you get the tip, it's too late. And the third thing is that it's very likely that you will not get any sort of personalized planning. You'll get some general planning that may or may not apply to you. It turns out everybody's situation is completely different. So don't go to an article or two and assume that that's the right plan for you. And Joe, it's unfortunate. Google and internet is fantastic. A lot of information.
Yeah, we love Google.
There's a lot of misinformation too.
Yeah, unfortunately, people have like a Frankenstein type of retirement plan, right? Because you hear this strategy, oh, that sounds cool. You hear that strategy, oh, that sounds good. And then you start putting this stuff together in your own situation, and it probably doesn't make any sense for your specific situation. Let's start with market timing. Does that make any sense at all? It could, right? So if you have that crystal ball, if you can perfectly time when to get in and then when to get out, and then guess what, when to get back in again, right? That's a phenomenal strategy, but no one really has the crystal ball. It's mostly cloudy. So do you want to have this perfect timing or maybe just time in the overall markets, right? If you can ride it out, this is very difficult to do. We would much rather have this. It makes us feel better because when markets go down, we still have to ride that down out. Ooh, that doesn't feel good. It's like, oh, let me get out because it's still going to go down. So timing in the market versus timing the market are two totally different things.
Well, they are, Joe. And you know, when you think about it, so when you watch CNBC or whatever you're reading or listening or Googling, you tend to hear things like, oh, well, you know, computers, technology stocks are going well or they're going poorly. Or what about commodities? Or what about this? What about gold? What about this? And so you have a tendency to think that you got to watch this 24/7 to figure out what the right trend is so you can make the right moves. This tends to be not a good strategy at all. You have to make a lot of right moves for this to work. And Joe, what's interesting is when you look at historical, even if you make perfect moves, it doesn't really make that much difference. And hardly anyone makes perfect moves.
Right, almost no one. Right, let's be honest. And then you look at other strategies is like buy what you know. I've heard that before. Peter Lynch, the great Peter Lynch of Fidelity. If you look at the pandemic, right, what did a lot of people do? They watched Netflix or they bought a Peloton, right? You would think, wow, those stocks are through the roof. I mean, they're both down at like all-time lows, right? I ride a Peloton almost daily, and the stock is down 95%. So buying what you know or thinking what is trendy might not necessarily work, because perfect timing, if you invest $2,000 annually in the S&P 500 and you timed it perfectly where that market was going to spike, you made $151,000. If you just invested January 1st, $135,000. What's the likelihood of this? Almost zero. What's the likelihood of this? Almost 100%. It's easy. You have to just deposit the money, right? And if you dollar cost average, you kind of pump that money in monthly throughout. It's a little bit about the same. Why even go here? It doesn't necessarily make a lot of sense, right? For the risk, the reward isn't necessarily that great. And always, this time is different, Al.
Well, it is. And when you look at this chart, it goes back all the way to 1900. You can see all kinds of declines and all kinds of increases. And I think, to me, the most important thing here, you look at the declines, like the Great Depression, like what happened right before World War II, right? The Great Recession, the dot-com bust, on and on and on. Yeah, the market goes down. We know it goes down. But look what happens right after. It goes up. And for people that try to market time, they may be selling as the market's going down, but then they're not in the market. They never know when to get back in, and they keep missing the rates of return. We know that for people that get in and out of the market, historically, you get about half the market return, if not less.
Do we have a treat for you? Right? Here's our special offer, our special gift for all of you today. It's ignore the hype. Right? There's a lot of hype out there, right? Well, you Google things and it's like all these hot articles, and then you read them and you're like, oh, I want to make these decisions. We're telling you to ignore it all. Find the right solutions, the right strategies. This book is free to you. Go to our website, yourmoneyyourwealth.com. Click on that special offer. It's by our own Brian Perry. He's our CIO, CFA, CFP, pretty smart guy. Yourmoneyyourwealth.com. Click on that special offer. Book is free to you. Okay, go to the website, yourmoneyyourwealth.com. We got to take a break. We'll be right back. Hey, welcome back to the program. Folks, show's called Your Money, Your Wealth. Joe Anderson, Big Al. We're talking about Google and how great it is for certain things, but for your financial advice, it's probably not the best choice. You get caught up in trends. You get caught up in market timing. There's no real true personalized plan for you, so ignore the hype. That's our free offer today. It's a book by Brian Perry. Go to yourmoneyyourwealth.com. Click on that special offer. Ignore the hype. It's a book. We'll send it out to you for free. Let's see how you did on the true-false question.
The average cryptocurrency investor invests $10,000 or more. True or false? I don't know. Do you know, Joe?
I have no clue, but I bet Mr. TV will tell us.
Oh, there we go.
Oh, it's true. All right, 10,000 or more. I don't know. Do you have crypto?
I don't.
I do not either. Not saying it's a bad investment. It's funny because this is the trend, right? It could be the absolute future, right? But it's funny how people are looking at trends and trying to figure out what is the next hot stock. GameStop, remember that?
I do remember that, and we actually had some of our employees buy some GameStop. Some made a bunch of money. Many lost a lot of money because they bought at the wrong time.
Right. I mean, look at this stock from 2015, 10, and then all of a sudden, all these people start blogging and Reddit, and then just shot up, right? And then now, right? But this is where most people bought. right? It's because that's all you heard, right? Oh my gosh, look at this stock and look at the trends and look at this. Here's another one, Alibaba.
Oh boy, I remember that one. We had a lot of people come in, probably 2016, 17, 18, and they would tell us that's the stock to buy. And it turned out, at least for short term, that's right. But I certainly would not invest my entire retirement savings on something like this, because look what happens later.
2017, great time to buy. 2021, probably a really good time to sell. Right? If we had that crystal ball, well, we would do this all day long, right? Then you ignored all this or you'd miss all that. And then we get into Bitcoin, of course. We're not just trying to trample on Bitcoin. I think, it could be, or the blockchain could be our future, right? But there's a lot of trends and it's so volatile and it's so confusing. And most average investors have no idea. I ran into my old college roommate, Alan.
Okay.
And he said he cashed out, he's a doctor.
Right.
Cashed out his retirement, bought Bitcoin, right? And it was like at $4 million. Talked to him today, it's probably worth 1.2. It's like, what are you, right? Your whole retirement on Bitcoin. So be careful. Is this appropriate in your overall portfolio? Absolutely it is. 100%? No. It's probably maybe 5%. Some of you, if you're younger, maybe a little bit more. If you're a little bit older, if you don't understand it, then don't probably invest in it. This is where we get in trouble, right?
Well, it is. So this is telling us that 1 in 5 of all of us out there are investing in cryptocurrency, which I'm not saying good or bad, just be careful, right? And then about 62% of you think you're going to be rich. You're going to get wealthy from Bitcoin. Be very careful about that. People are investing $10,000 and then they're like, I'm going to get rich. I'm going to strike gold, right? Ned Clampett, here we come. Right, so 62% of you are thinking you're going to get rich. It's a get rich quick kind of mentality. Investing should be boring, right? It should be watching the grass grow. That's what investing should look like. A portion of your portfolio, if you want to take on a little extra risk, by all means, that's your play money, or go to Vegas or do whatever, right? But if your philosophy and strategy is, hey, I'm going to get in now and I'm going to get rich from this, could that happen? Yes. The likelihood of that happening is probably very, very, very low. Ignore the hype, folks. Here's our gift to you this week. Go to yourmoneyyourwealth.com. Click on that special offer. You got to ignore most of this stuff. Sound investment principles. True financial planning is in this book. I just sound self-serving there, but this is free. There's no strings attached. Just go to our website, yourmoneyyourwealth.com. Click on it if you want a good read. By all means, it's our gift to you. If you don't want to read it, then don't click on the button. All right, we got to take another break. We'll be back in just a second. Hey, welcome back, folks. Show's called Your Money, Your Wealth. Joe Anderson, Big Al. We're talking about financial planning and where to find the advice, and Google is probably not the best choice for that, especially when you're market timing, finding those hot trends, trying to get rich quick. We're talking about boring stuff, doing the sound principles of your overall financial plan. And let's kind of dive right in, Big Al. Yeah, so starting with what you should do. So we've just been telling you what you shouldn't do. So the first thing is to set a goal. What's your goal? And so what does that mean? It means, okay, I want to retire in 5 years. And I want to live on $80,000 a year, whatever the number is, it doesn't matter. So that's your goal. And how did you get $80,000? Well, I want to travel more. I'm spending 60 or 70 now. I want to spend a little bit more for travel. Or maybe I want to buy a vacation home, so I need to have a little bit of extra income for that. Or whatever your goal is. Maybe it's $40,000 a year, maybe it's $400,000. I don't care what the number is, but set your goal, figure out your time frame, and then take a look at, does it make sense? The time horizon. Are you going to make it, right? If your goal is to spend $400,000 a year and you only have $400,000, you're retiring next year, it's not going to work, Joe, because you got 1 year.
Yeah. Good point. Good math. But that's key. I think take this a step further. When you're setting a goal, is write it down. Okay. I think, hey, I want to retire in 5 years. Well, then write it down. Hey, we're spending $100,000 this year. Do you want to maintain that lifestyle? If it is, write it down. More people are more apt to accomplish their goals if they just simply write it down instead of just thinking about it. So setting those goals, talking to your loved ones. Make sure that you're on the same page. Here's another one. With husband and wife, what are the highest divorce rates right now are people or couples in their 60s. And why do you think that is? Is because they're spending so much time together, right? And they're not necessarily communicating. There was a survey ran, and they talked to the spouses, and they asked them the same question. What is your number one thing that you want to do once you retired? They asked the wife, okay? Then they asked the husband. The husband's number one answer, the male, was like, I want to spend more time with my spouse, right? Then they asked the wife, do you think I want to spend more time with my spouse? What's the number one answer? No, it didn't even make the top 50. Okay? So you have to communicate, set these goals, looking at your time horizon. Is it 5 years, 10 years, 15 years? Is it tomorrow? Right? Are you financially independent today where you can just walk off the set and retire? Right? That's what Big L's going to do. Then you look at your risk. There's an expected rate of return that you need to generate, but then also a gut check. Can you handle that risk? Right? Hey, I don't like the volatility. Well, then maybe you got to tone the risk down. Are you okay with that in regards to your overall goal in your time horizon? And then diversify and then rebalance.
Yeah, well, no question. I mean, it's simple as that, right? And when you're setting the goals, here's a quick kind of rule of thumb as to think about, and that is whatever your assets are, your liquid assets, what your investments in your retirement accounts, outside your retirement accounts, multiply the balance times 4%, and that's roughly what you can spend. Is that gospel? No, it's not at all. But at least it gives you an idea. If you want to spend $40,000 a year and you got $100,000, well, that's not 4%, that's 40%. It's not going to work. So it just gives you kind of a guideline of what you need.
Yeah, this is at least gets you kind of in a time frame of saying, all right, am I close, right? Because if I look at it like this, first thing, set the goal, okay? Well, what's the goal? All right, well, I don't know, I want to spend X amount of dollars. I want to spend $100,000 a year. Well, can I do it? Well, first thing, you look at your Social Security benefits. What do you think you'll receive there? Okay, write it down. If you have a pension, or if you have real estate income, or if you have part-time work, or if you have whatever other type of fixed income source coming in, write it down. Okay, so your fixed income is key. That is like, let's say, your guaranteed income source. Then you look at your liquid savings. In this example, $700,000 this couple had. All right, well, great. They got $32,000 of combined Social Security, some pensions, $700,000. You take 4% of the 700, that's 28. You add them all up, that's 80 grand. Well, my goal was 100, but here, this is telling me I can only spend 80. Of course I can spend 100, but the likelihood of me running out of money is a lot higher. So we want to stay in that 4% or lower, okay? And it's not gospel, like Al said. This is just a good high level, 30,000 feet view of someone's overall retirement.
Yeah, and I think the closer you are to retirement, the more accurate this becomes, but it's something you ought to be looking at all the way through. Now, another thought here is if you run through this example, you want to retire in a couple years, and you wanted to spend $100,000, but you can only spend 80. Okay, well, you need to make some changes, right? What are the changes? Well, you could work a little bit longer. You could work part-time in retirement. You could spend a little bit less. You could sell your home, downsize. There's all kinds of things you can do. You don't have to stay in that job forever, right? But you may have to make some changes. Another way to think about this is if I want to spend 100 and I only have I currently can spend 80 and I have $700,000 to do it plus the other income, then what do I need? And in this example, you need 1.2 million times 4% to get to that 100. So just do a little bit of math to get yourself to where you need to be.
Then you have to look at your investments, okay? So this is another guide, if you will. Like if I'm in my 20s or 30s, you probably want to have more stocks. So the green in this are stocks, the yellow is fixed income, cash, CDs, bonds, things like that. So if I'm a little bit younger, I can, right, and of course this is for my retirement, so I have a lot longer time frame. And as I get closer to my retirement, right, then that's when you want to turn on a little bit more bonds, right? This fixed income is going to be your safety valve, right? So when markets go down, you have a place to continue to grab from that you're not selling stocks when they're low. Sometimes we see people in their 60s and 70s that are looking to retire next year and they have a portfolio like this. We get a ton of calls, emails from all of you saying, hey, should I postpone my retirement? I was looking at retirement this year. The market's down 20%. I think I need to postpone it. Why did they have to postpone it, or why are they asking us? Because they probably had the wrong portfolio.
Yeah, I think that's right. And of course, as you said, Joe, this is just a guideline, right? The concept is you can be more aggressive when you're younger because you have more time, less aggressive when you're older because you need to withdraw those funds. But this is certainly not true for everybody. Sometimes people are in their 70s and 80s and they have 100% stocks. Why? Because it's for their grandkids. So the time horizon is a lot longer. So every situation is a little bit different.
You know, then you look at all of these different weird names: small cap, mid cap, large cap, right? Growth, value. What does all of this stuff mean? So this is risk and return, all right? If I'm looking at here, the higher the return, the more risk I have to take. So small cap, what's small cap? Those are smaller companies. And it's intuitive, right? Because if I'm a small company, I'm a startup or something like that, right? If I make it big, I'm going to have a pretty good return. But the likelihood of small companies making it big is pretty low. So that's why there's that much more risk. A lot of small companies fail. Only a few succeed. So that's why you're rewarded for the risk that you take. So then you have to look, right, now a little bit more micro. This was macro, then you get into micro, mid cap, large cap, and so on. So make sure that you understand exactly what you're getting into as well, and then that's going to determine the overall volatility. And then finally, making sure that you're controlling the risk long term, right? As markets go up, those stocks will continue to rise, okay? Well, then your bonds or your safe money is going to be less. You want to make sure that you continue to rebalance, all right? Or vice versa, right? If this is kind of where we're at now, well, I probably want to buy more stocks today while they're down 10, 15, 20%. So making sure that you're controlling your risk. All right, let's switch gears real quick. Let's go to Ask the Expert.
This is from Rob. My wife wants to buy a condo that we know will not cash flow, but we're hoping the value will increase over time and we'll write off the loss in the meantime. Is this a sound investment strategy? Rob, great question. We get this all the time, particularly for people that live in like California or high-cost states because properties are so expensive and they don't tend to cash flow. You can make money on it, and a lot of people do, but you have to be more careful, right? Because there are downturns. In fact, right now as we film this show, prices are dropping a little bit in California. So just be aware of that. You may not get the appreciation that you're thinking. A much better approach is to have a property that does cash flow. You can ride out markets, good and bad. It's not that you can't make money on this kind of investment, but it's just a lot more risky.
Yeah, and you don't want to necessarily buy an investment for like a tax break, right? I mean, there's a lot of really bad investments that could give you a tax credit, you know, and that may or may not make sense as well. So if you are cash flow negative, then you're betting on appreciation, and if the market dips, oops. Let's go to the next one.
Number 2, Seth, I lost my shirt investing in cryptocurrency. Can I use tax loss harvesting to offset the losses? Certainly, but you have to sell that cryptocurrency, which you may or may not want to. Maybe you can buy another cryptocurrency to stay in that kind of market. And then you can use those losses against any other capital gains that you have.
So what did we learn today? Well, first of all, it's tough to time the market. Probably don't even try. When you are following trends, right, you could get lucky, but again, most of us will probably miss the boat there. You know, base your portfolio based on your goals, your risk tolerance, taxes, and everything else, and make sure that you create that customized plan. If you want help with that, here's a free book for you. It's called Ignore the Hype by Brian Perry. He's a CFA, CFP. He's our CIO here at Pure Financial Advisors. Ignore the Hype. Go to yourmoneywealth.com. Click on that special offer. We've got a limited offer here, so we're only going to get these to the first people that click. So get on your computer, folks. yourmoneywealth.com. Click on that special offer. That's our gift to you. We'll mail it out to you. All right, that's it for us. For Big Al Clopine, I'm Joe Anderson. We will see you next time.